All right, lots to cover. Thomas Hayes joins us, founder and chairman of Great Hill Capital. Good to see you again. I told Nanuka we need about 2 hours to discuss everything that's on the plate. Let me first get to the most current relevant news, which was this talk about the debt ceiling. I'm sure you saw this earlier. There was a headline about Fitch possibly considering downgrading the U.S. debt. We saw this play out about 10 years ago, the last time around with this. And we actually did get downgraded, remember, with the S&P. Yeah. And I got to think, do you think this will put more pressure on two sides to just get it done before the weekend? I'm a little nervous. We wait till after the weekend. Too many things can happen.
100%, Phil, and thanks for having me. I think that this Fitch timing of the negative watch for the U.S. credit rating is going to light a fire on both sides. I do think that they're getting closer. There's some concessions coming out of the White House. I think McCarthy knows what he wants. I think they know where they're going to wind up. But rather than dragging it out to June 1st and then telling us they have another 30 days of cash, I think now there's some real risk. If you get downgraded, that has big knock-on effects. And Fitch is basically saying, get your act together, get something done. And I wouldn't be surprised, to your point, if we do get something done before the weekend or over the weekend and just tie this thing up. I mean, the Democrats are clear. You look at the deficit, spending has to be contained. They don't want it rolled back. They want it capped where it is. Republicans want to roll it back to 2022 levels. They'll figure it out, but now they have that fire that's essential.
Right, and then there's the flip side of the coin, because if you are in debt and I'm issuing debt to you to buy debt, and I'm setting the interest rates more or less, you don't want the rates to be so high. And that gets to the second question is, we've heard a lot of chatter that inflation is still not under control. We're not at the 2% target. The Fed might still raise rates. I've heard lots of bits and pieces about it. The market doesn't seem to believe this narrative at all. And you saw the markets, for the most part, rally over the past couple of weeks into a territory where I think some would call maybe a blue sky event. In other words, things are all solved, the debt ceiling is solved, no more interest rate hikes, and we can focus on earnings again. Is the market getting this right?
Partially. If you look at the Atlanta GDP now estimates for Q2, it's a plus 2.9%. So despite all the tightening, the economy's humming along. Earnings were much better than expected, came in at negative 2.2 versus negative 6.7% estimates. 2023 estimates are holding up between $246 and $250 for the S&P 500. And you have positioning flat-footed, Phil. You know, markets don't top when everyone's overweight cash, $5.3 trillion in money markets. Managers have the most overweight bonds relative to stocks since the lows in the great financial crisis in March of 2009. So rarely does the market reward people when everyone's cautious at the same time. It doesn't drop 10% to let them buy cheaper. Usually the pain trade is up and the markets push higher to force that cash to chase up at higher levels. And then you see NVIDIA, like you pointed out, they beat revenues by 19% this quarter. They guided they're going to beat by 33% next quarter.
Absolutely crushed it. And
we may have the runway for a roaring 2020s. You know, like we had the roaring 20s after the Spanish flu, we may have the roaring 2020s after the COVID, and AI could be the productivity driver, and that will drive all industries, all GDP. So I think there's some positives, but they got to get this job done this week.
Chip stocks are up in sympathy on the back of your discussing NVIDIA numbers. AMD was up after hours. A number of other chip stocks were up. And so I guess my question to you is this AI thing. I don't know if you have positions on these chip stocks or not, but everyone's talking about it. And I get a little bit nervous when everybody's on the bandwagon. But to your point, maybe not everyone's on that bandwagon, and there's still room to grow.
I think there is room to grow, and I think there's some outlier companies that maybe aren't as headline as NVIDIA that will catch up, that will be able to participate in data center and benefit from that. So we have a basket of semiconductors. We bought those in the fall when no one was interested. We bought more boring than NVIDIA. I wish we had bought NVIDIA, but we didn't. But we've got semiconductor exposure. The whole group has been up big time since October of last year.
Give us a couple names you'd buy tomorrow. The market's going to be up. Chip stock's going to be up tomorrow. We have to make a decision, right? Either you jump on it or you let it run.
I would never jump on it at this point. But what we do like for the long term, not the short term trade, but for the long term, we do think there's value in Intel just on the basis of the PC business coming back, the data center business coming back, the basic chips that they control the market. All that push forward is working through. We think we had inventory peaks in Q1. So in the quarters to come, that could be a double over the next 12 to 18 months. And then, by the way, if their promises of a brighter future, Gelsinger's laid out this amazing future with AI and the foundries and all that stuff. If that happens, it could be more. But we're just looking at the basics, the areas they control, PC, data center servers, et cetera. And if they can do that alone, we think the stock is undervalued. It's a boring one, but we're value guys.
The rest of the marketplace, if this interview took place 2 months ago, we'd be talking about the banks blowing up. We'd be talking about all these terrible things that are happening, but we're all just ignoring all the negative headlines and focusing on the positive ones. But come this summer, will we be still talking about the banks, or has that sailed off? Has that issue gone away? And you're saying investors can take money from cash and put it into the markets, and if so, which sectors?
Yeah, I think that what's going to happen after this debt ceiling is completed and the Fed either skips or pauses at the Fed meeting is the dollar, that recent bid that we've got coming into this debt ceiling problem because the US dollar is a safe haven, kind of hurt emerging market stocks, hurt China stocks, et cetera. I think once this is behind us, the dollar is going to start to resume its downtrend that it started in October. I think emerging markets is going to start to get a bid. China's a part of that. I think that'll simmer down. You're seeing some dialogue improving between the countries. So I think there's a tremendous amount of opportunity. There's AI opportunity in China as well. So we do like those stocks. We certainly like some of the U.S. chips. We think some of the bigger banks, we bought a little Bank of America during the crisis. We think that's an opportunity. Maybe some of the super regionals were less sanguine on that front. But there are things to do on a selective basis. It's not just buy the S&P, don't buy the S&P. It's looking at individual companies on a one-by-one basis and seeing where the value is. And those are some of the things we're looking at right now.
Well, look, for our viewers, for the record, you've nailed a couple of these pretty good over the past couple of months. So congratulations. We'll talk to you more about this. Thank you. Always good to see him.
Appreciate it, Phil.
More company news now. Tech